Hey everyone, PayPal stock fell nearly 10% after releasing its latest quarterly earnings results, after bouncing back a little bit to being down roughly 5%. So what's going on with PayPal stock? That's what I'm going to discuss in this video here, highlighting what the new CEO mentioned about the latest quarterly update and their goals for 2024. So let's get into these interesting details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So like I mentioned, PayPal got a new CEO, James Alexander Chris, president and CEO of PayPal now. It's been 4 months, right? And the CEO highlights that it's been a productive 4 months, but it's only been 4 months nevertheless. You cannot change very much in just 4 months, especially if you've got to get situated, you've got to understand the situation. You're not going to make very many changes in the first 4 months, although the new CEO already made some big plans. So let's take a look here. In the fourth quarter, they delivered 9% revenue growth on $410 billion in total payment volume. Transaction margin dollar performance was better than expected in Q4, and they continue with strong expense discipline, reducing non-transaction related expenses by 9% year over year. And that little statement there says a lot about what's happening at PayPal. Number one, growth is slowing down, and you saw that with transaction margin dollar performance being relatively flat. They're cutting costs to try and improve profitability as the business shifts from its higher margin branded checkout experience to the non-branded checkout experience. And we're going to see more about that a little bit later. Earnings per share increased by 19% year over year in the fourth quarter, and overall 2023 was a great year for earnings growth for PayPal, although 2024 looks like it's going to be a different story in terms of earnings, as management forecasts flat earnings per share in 2024. That's one of the reasons why the stock price initially crashed 10% right after that announcement was made. So last week, they announced that they'll reduce their global workforce by approximately 9% through both direct reductions and the elimination of open roles over the course of the year. And if you've been a subscriber on the channel for over a year, you would have noticed that there's been a lot of tech companies, a lot of companies overall doing cost cutting and job cutting, restructuring, and all of the above. And I've been critical of the companies that have been doing it poorly. There have been companies that have been doing it well. One of the companies that I've been critical about doing it poorly was Alphabet, because they experienced billions in restructuring expense to let go of a few thousand workers. Now, they were extremely generous with their severance packages, and that raised the question on my behalf, why do job cuts at all? Why have a cost-cutting plan at all if it's going to cost you billions of dollars in severance, right? And here is an example of the way I like to see job cuts being done, by eliminating open roles over the course of the year. So not hiring and letting attrition reduce your workforce. Not hiring and letting attrition reduce your workforce. That way, you're not paying severance for employees that you're letting go of, and you're not firing people that want to be there. You're losing employees that are quitting. They no longer want to be there. They're looking for other opportunities and jumping ship as soon as they see a better opportunity for more pay, or maybe they're approaching retirement age and retiring. And so you're getting a reduction in force without all the expense, without all the disruption, without reducing employee morale, because you're letting go of people that want to be there, keeping people that might not want to be there. So far, I like the strategy here already from the new CEO. In the first major decision the new CEO made, I'm liking the direction this CEO is taking. Reducing workforce by eliminating open roles throughout the year. So the priorities they're going to focus on this year include accelerating growth in the branded checkout business and improving overall profitability while unlocking the power of data. So far, that sounds good. We're going to need to see more details to understand specifically what that means. I already mentioned the branded checkout business is the more profitable business for PayPal. So I like to see that the management is focusing more on the more profitable side of the business. They've already shown us they're focusing on cost by letting go of nearly 9% of the workforce, or reducing workforce by 9%. And then unlocking the power of data seems like an interesting initiative, especially with the increasing effectiveness of artificial intelligence. I'd be interested to see how PayPal harnesses their data, harnesses AI to connect merchants with consumers. That will be interesting to see, right? They have over 400 million active accounts. I don't think they're optimizing those accounts. I don't think they're connecting merchants and users as effectively as they could be. So this is an interesting opportunity for sure. However, management is, lowering expectations here and saying it'll take time for our initiatives to scale and move the needle, but the initial customer reaction and merchant demand for new innovations has been encouraging. 2024 is going to be a transition year. So telling investors, don't expect anything big in 2024. We're transitioning the business. We're moving over to this new strategy. We're doing all of these new things that we don't expect will take hold in 2024, although that's a long time to adjust and change course for a company that's not really in that much financial difficulty. It's a profitable company. It's generating billions in cash flow. It's not undergoing any major changes in the business other than just a change in the structure of how the payments are coming in from the branded checkout side to the unbranded checkout side, which isn't this huge, massive change in the business. So I don't think it should take a year, although I think management is being cautious in saying that it will. So they've made some strategic decisions to reinvest the cost savings back into their most important initiatives, and they want to capture their share of global commerce. Now, I would have preferred to see them say their share of global e-commerce and not commerce. I'd prefer PayPal focus on the online parts of its business rather than focusing on business overall. Although that's just my personal preference. Of course, the global commerce industry is much larger than the e-commerce industry, and so that gives the company a wider total addressable market to go after. Although I don't see PayPal as having any competitive advantages or any meaningful competitive advantages in in-person commerce, in business, in brick and mortar business. But I do see PayPal having a significant advantage in online business, in e-commerce, because its branded checkout, the PayPal checkout, is so much more convenient than taking out your credit card and putting in your credit card information when you're making an online purchase. When you visit a new website where you don't have your credit card information on file, you have to take out your credit card, type in all that information. It takes much longer than if you have PayPal and the website recognizes you have PayPal and you just automatically log in and you can make the purchase in much shorter amount of time. And so that's where I feel PayPal has a competitive advantage. That's where I prefer PayPal focus on and be better at that, be better at connecting consumers and merchants online and focus on that core category. Still, I understand management wants to capture the share of all commerce, which is a much, much larger addressable market opportunity. So already we're seeing the direction that PayPal is going under new CEO, and a few of the moves I agree with, especially the strategy for the cost cutting, the layoffs. I like that. I'm interested to see how they're going to unlock the power of their data. That seems like an untapped opportunity that they can certainly unlock and generate more revenue, more profitability, and I'm curious to see that. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.